morning. I'm glad we are, you all are taking the time out on a Saturday morning and attending this this new introduction. It's in the AIF segment. AIF, as most of us know, it's an alternate investment fund. Your investment starts with a minimum 1 crore. Now, some of you might be on this call thinking, okay, Sharath, why am I on this call when we don't probably have the liquidity or the budget? I'm currently The intent is to get you all exposed to another asset class altogether, which none of us at the moment have exposures to. Okay. And we will not have. The point is, we will not have. It's in the unlisted space. Now, some of you will say, Sharath, but unlisted space is something that you already introduced us to some time back. Now, I will let Nishad, I will not steal Nishad's spotlight here, but the differentiation between what was offered before was just exchange of shares. You're buying it from another investor or another dealer out there. You're not buying it straight from the company. Okay, that's the predominant difference. I don't want to steal Nishad's thunder. So what I'm going to be doing is I will, with that context in mind, the intent of sharing this is so that, as you'll already know, a good deal of our portfolio construct happens mainly with the intent of diversification, and everything else comes secondary, right? Now, unfortunately, yes, it's a minimum ticket size of 1 CR. In fact, the previous series of Bharat Value Fund was going at a minimum of 2 CR. This time, this is the fourth series that is come along. And again, Nishad will talk more on the details. We will get on the logistics and everything towards the end of the call. But the intent is, first of all, to understand how is this instrument different? Number one, how are we protecting our capital? Number two, what happens in case the worst were to happen? And how is this truly diversified when compared to everything else that we're currently doing? When I say everything else, I'm talking about the PMSs, I'm talking about the mutual funds, I'm talking about the fixed income instruments, everything that we're doing. We currently will not have exposure in a significant manner to this sector that we're going to get introduced to. So with that said, what I'm going to be doing is I'm going to leave the stage to Nishad. But before that, I'm going to be giving a quick introduction to him. He has been the founding member of the investment team, and with over 22 years of experience in the investment and fund management space, Nishad leads the Bharat Value Fund with a clear mission to uncover long-term value in India's most promising businesses. Please note, I said businesses. I didn't say startups. I didn't say venture funds. None of those things, right? So I'm talking about investing in India's most promising businesses. Now, he's known for a disciplined, research-driven, exit-oriented investment style, and Nishad comes with a deep market insight with a sharp eye for undervalued opportunities, backed by a strong academic and professional foundation. He brings both analytical rigor and real world wisdom into the portfolio. Now, he's got a lot of accolades in terms of the companies that he's worked for previously, and how he moved on to the wealth company. But like I said, I think it's best I give the stage over to Nishad. Nishad, all over to you. Before we begin, Nishad, I want you to know the audience that we are currently addressing and will address in the future via these recordings are folks that they don't come to me with large amounts of liquidity. What has ended up happening is, as a discipline process, what we do is we get people to bump up their SIP contribution. So at an average, our families invest anywhere between 1.5 lakh to 2 lakhs per month. And this goes in about good 3 years, 4 years. And after that, when the corpus is large enough, when that prudence is set in, when that extra liquidity comes in, bonus money comes in, we start protecting that money. And eventually, when the portfolio is large enough, that's when we start diversifying into instruments that individual investors will not have exposures to. And we follow a rule, which is basically, if their minimum investment is X, they don't get exposure to it unless it's a 3X holding. I'm not including real estate, and I'm not including EPFs, PPFs, or whatever that is. All of this is liquid investment. I'm giving this background to you, Nishad, because I've seen your previous presentations and your audience. They are relatively very different from at least my set of audience who are going to be listening to it. And that's why I thought it was important. If you're going to be quoting examples, if you're going to be quoting real life scenarios, it is important that you have this background and context. So with that said, all over to you, Nishad.
Thank you, Sarajay. First of all, thanks for inviting me on this your webinar, and thanks for introducing me and my colleague Mr. Dashnik Nayak, who is the head of my business development. He's also with me in this call. So this presentation would be given by both of us in a joint way.
Right.
So, being a Saturday morning, as you rightly said, I'm not going to bombard with too many jargons. Typically, when a fund manager comes, he starts using with alpha and beta. I'm not going to use any alpha and beta because I myself do not understand what is alpha and beta. I'm very honest with that. So before I start, since Sharath bhai, you and me both are regulated by the regulators, that's called SEBI. So I just wanted to use a one mandatory disclaimer because it's going. You're going to record it that what I'm going to do that all the investors, all the listeners listening to this in live or off live should consider this event only as an for the purpose of educational awareness. As a fund house, myself, my the colleague Dashnik and Sarath Bhai, even you, we do not assure any kind of a returns or any kind of a guaranteed returns. That's not the policy and that's not even the regulators allow. So that's a mandatory disclosure I wanted to flash. And now let's start the educational seminar. So what is this all about? So I am not going to show 10 slides, maybe three at max four slides. The fourth slide is about the past performances, but the three slide I'm going to conclude the entire AIF industry. So this is the product called as a alternative investment fund, short form AIF. So there are basically three kinds of AIF that are prevailing into India: Cat 1, Cat 2, and Cat 3. Cat 1, Sarath Bhai, is more like a startup venture capital where early stage investors are there, so they take a long horizon, they take a bet on the concept and all those things. Cat 3 is more like a listed, you can compare at par with the PMS or mutual fund, but with the only flavor that Cat 3 are allowed to invest up to certain percentage in unlisted also, but it's predominantly listed. What I am is Cat 2, category 2. So today we are going to discuss category 2. Category 2 again have two wings. One is debt, one is equity. This is not a debt product at all. This is a category 2 equity product. Sarath bhai, we started this operations 12th April 2022. On that day, our AUM, we call asset under management, was practically zero. And today we are become almost 6,000 crore. That is, I think, sizable amount we are raised. Of course, the performance speaks. But more than the performance, I'm going to put the performance at the last. I would cover the entire presentation. I can cover the entire presentation in 30 seconds. Today we are into the fourth series. The series 1, series 2, series 3, series 4 are from the regulatory perspective because the regulators ask us to close the series after certain events happen. But across four series, the theme of the fund is simple, and that is invest in those companies which are IPOable in 3 years period of time. On a higher side, 3.5. इन हिंदी इफ आई एम स्पीकिंग उसी कंपनी में पैसा लगाओ जिसका आईपीओ अगले 3 या 3.5 साल में आने वाला है. शरद भाई, वेरी फ्रेंकली स्पीकिंग, द प्रेजेंटेशन इज ओवर. I have nothing to speak beyond that. That's a simple end objective because I personally believe unlisted sector can give you better returns as compared to, or probably superior returns as compared to the other sectors. Why? Because it is not still in a public domain. That's a correct statement, but it's a half statement. Unlisted can give you better returns only and only if your fund manager knows how to make an exit. If the fund manager manages to make an exit, the return comes to your bank account. If the fund manager fails to make an exit, the return lies only into the paper. Now it's your call whether you want a return in paper or you want a return into bank account. So that's how we manage invest in those companies which are IPOable in 3 years time. So before jumping on to the fund, there is something, a mechanism how we manage it. So invariably, wherever you're investing in any product, say debt, equity, Sarath bhai, most of the time people, investors have seen making one small error. Even I myself used to make that error, and that error is they look at the face of the fund manager and then they invest. In my opinion, that's a wrong strategy. Sole fund manager can never make the fund successful. What matters is what is the background behind him. The background behind the fund manager is equally important. Background of the fund manager contributes to the success of the fund. It's like a cricket only. You cannot have the one batsman and he can make you win the entire. He can make one of victory, but not the entire series. So first point, I'm going to show you what is the background about my group. We are 357 people operating from Mumbai. Who are we? And how does my background helps me in achieving my target? Remember, my target is invest in those companies which are IPO in 3 to 3.5 years period of time. So background about the group, I'm going to speak the first. Then probably how do I exit? How do I entry? And till today, series 1, series 2, series 3, whatever companies I have invested, what have been the predominant selection parameters? And then I leave it to open. Probably I would be speaking for another 20-25 minutes, not more than that. But I'll keep it very slow. Couple of questions would come. I request we can keep the Q&A at the end of the session. Hope that is okay with you. So let's start with the presentation. As I promised, not more than 3 slides. So this is our building. This is not a first slide. This is just a background. So this is our building. Those who are from Mumbai, Andheri, our office is at Andheri Sakinaka. This entire 7 floor building is owned by us. So that's where we operate. Myself, Dashnik, and entire series. All of our colleagues operate from the same premises. So Sarath bhai, very well, very clear. As I said, the background about the group is directly attributable towards the success of the fund. And this is not a sole fund manager. So this slide is a background about the group. What are we? So on the top, wealth company investment manager, that is my fund. So I'm not going to talk about my fund. I'm going to talk about the support pillars of the fund. So the most important support pillar of the fund you can talk about is a Pentomath group. What is Pentomath group? Pentomath group is India's largest mid-market merchant bank. What is merchant bank? Merchant bank is the license issued by regulators to do IPOs. So whatever IPOs come into India, they have to be submitted by the merchant banker. So merchant bankers are responsible for successful completion of the IPO. As a merchant banking unit, merchant banker never invest in IPO, point to be clear. As a fund, we invest into companies. Merchant banker never invest, they only help in completing the unlisted company to the listed company. So as a merchant banking unit has done 118 IPOs, 118 IPOs in last 12 years. So that's probably one of the highest in India. That is practically served by one IPO per. We had our three main board IPOs. Highway infrastructure was our, Regal was our, and Vikrant engineering was also done by Pentomath. So that is probably three main board IPOs in a single month. So what I'm trying to establish, Pentomath knows how to take a mid-sized company to the IPO. See, as and when I'm completing pillar, you will come to know how I'm achieving my end goal of taking company to IPO in 3 years. So first company knows how to take a mid-sized company to the IPO, and that's what they have been doing for last 12 years. They have 6 IPOs in pipeline coming in next 3 to 4 months. Then second pillar where my cursor is there, Asit C. Mehta. One of the oldest broking house in India. The owner of Asit C. Mehta is Miss Dina Mehta. Dina was the first and only lady chairman of Bombay Stock Exchange where we all trade day in and day out. So they have the history of 42 years into research. India's each and every institution, most of the bigger institution like mutual funds, insurance and bank, they support the Asit C. Mehta provides them the research report and support them. So what has happened? Whenever you do IPO, Sarath bhai, there are two main important things without which your IPO is impossible. Point number one, clear the compliances of your investee company. Because if the compliances are not clear, regulators are not going to give you a green signal. So that's done by Pentomath. And second, clearing your compliances is 50% job done. The 50% job is how can you attract a bigger investors to your IPO? Better the quality of the investor, bigger the anchoring investors, ultimately the IPO opens in a bigger way. So that anchor investors getting, anchor is nothing but mutual fund, insurance and bank. In each and every IPO you do, the 30% of the lot has to be mandatorily initially subscribed by the anchor investors. So quality of the anchor decides the outcome of the performance. For example, my last investment quality power, I'm almost trading at I think 2.7x in 9 months. Probably the reason could go, I can say, of course, the company is doing well, but LIC has invested over there. So since it has the India's top-notch fund has invested over there, so of course the performance speaks. So Asit C. Mehta, because of their traditional 42 years legacy, they can attract, they know they have access to the India's bigger anchor investors. So first pillar helps you to complete the compliances. Second pillar helps you in attracting the good anchor investors.
Nishad,
Let's
1 minute. I'm sorry. I know you said questions to the last, but I'd like to play the role of a moderator because I know the kind of questions my audience will have. Now, to save us the trouble towards the end and not, I don't want some of us getting lost in thought. Help us understand that you've told us what an anchor investor does, but what is the importance of an anchor investor? Let's touch upon that topic so it clarifies this point in terms of the pedigree that comes along with Asset C method.
Yeah. So what happens, Sarath, say a company XYZ Limited. XYZ
Mm,
Limited gets a anchor in, say, regulator approval today. So
mm,
once you get the regulatory approval, so most important is the price discovery.
mm.
So regulators have a very simple formula that let market do the price discovery. So regulators say, suppose you're raising 1,000 crore from the market. Example, in
Right.
a, they say, okay, do one thing, you can raise 1,000 crore, but at least get a commitment from anchor investors upfront for 30%. So if the
Mm.
anchor investors, which is only four people, mutual fund, insurance, bank, and AIF like me, if they come and say, okay, I am happy to invest, say, 300 crore at say 97 rupee per share. So that
Mm.
becomes the benchmark price. So
Now, the reason why. Yeah, the importance of this anchor investors coming in and putting 30%. How does that impact overall journey of that of the company that's looking at going public?
Excellent question. So what happens when the good anchor comes? It is believed that they have done as a retailers or as a HNI. Sarath bhai,
Mhm.
you probably you will do it because you are a wealth manager. But retailers are not expected to do deep dive into the company, study the balance sheet, study the profession,
Mm.
what are the contracts in hand, what is the debt equity ratio. They don't do. So they rely on somebody. So for
Mm.
example, today your investors while investing in my fund, they rely on you.
Mm.
So when retailers invest in IPO, they rely on somebody's due diligence. Who is that somebody? So when the better the anchor investors, so they have the better research team, and they have been predominantly investing in good IPOs. So what happens if the good anchor investors are showing interest in a particular IPO? Retailers get a kind of a comfort. Okay, say India's number one bank, India's top five institutions are investing into this IPO. This has to be a reasonably good IPO because this must be a well-researched IPO. That's what the belief is there.
So
And
basically, we're not talking about a pump and dump or whatever it is. There is depth in it. There is people going to hold into the fund for a long time. It's not just going to, on listing gains, the fund is not going to get up. There will be no volatility or difference of humongous volatility in the open and closing of the respective stock prices.
correct, because anchor investors, as per regulators, they are
Mm.
locked in for 50% of the contribution 1 month, 50% for 3 months. So that
Right.
gives a little bit of a safety to the retailers. Okay, anchors are locked in, so there will not be price movement immediately post the IPO. So that's a good
Right.
point. And the good anchor investors are known into the market for not selling for 2 to 3 years. So that
Mm.
gives further price, you can say, a safety, because the anchor investors are not selling, so price is stable. So
Mm.
that is a very important factor about getting a quality investors for the
Mm.
on the date of your IPO. So that's the
Right.
about Asit C. Mehta. As we started moving ahead, the first fund we did fantastically well. I'm technically trading at 3 times in 17 months my investment, but we started facing certain difficulties, and that difficulties were, okay, I'm giving money to a certain company, but how do I ensure? See, if you know I have invested in the company is going to go for IPO in 3 years. Promoter also of the company also knows, na. So promoter
Mm.
of the company is, if he knows he's going to go for IPO in 3 years, what he will do? He will take my money and start chasing the revenue, because more
Mm.
the revenue, more the valuation.
Mm.
But when he start chasing the revenue, by default, he will attract the bad debts.
Mm.
Law of the nature. As a fund manager, how do I stop my investing company from having a, loss making proposals? I
Right.
into the day-to-day operations, that's highly impossible. So what
Mm.
I've done, I've invested heavily into AI. So Analyst.ai is such an analytical app which helps my investing company promoters in checking the health of their contractors. For example, if you're supplying goods to somebody, at least check that guy is particularly paying GST on time, TDS on time, whether the
Mm.
person has a criminal liability on them. So this is the basic health check of your suppliers you do and the contractors you do, so that my investing company does not end up suffering a big losses and they get a kind of
Understood.
due diligence upfront. So that's where also I help. The
Mm.
next point is lead sensor. Lead sense is all about data. Sarath, in today's world, those who have the better data are going to win the race. There is no second thought about that. So
Mm.
I also want my investing company to grow their revenue. But how? If I'm expecting I'm giving them the money and they will grow the revenue, sorry, I'm staying in a fool's paradise. That's not going to happen.
Mm.
That's not going to happen. So I need to give them a data also. So if you get the proper data, and that's where the growth happen. So Sarath bhai, just look at this entire sheet once again and imagine you are a promoter and you want to go for IPO in 3 years. Just
Mm.
think over it. As a fund manager, what am I giving you? Number one, as a wealth company, as a fund, I'm giving you money. Of course, that's my core credential. But am
Mm.
I only a financial investor? No, Sarath bhai. I'm not only a financial investor. I'm much beyond that. As a Pentomath group, we can help you in clearing the compliances, because that is the 50% battle is won. As a Asit
Mm.
Mehta, good anchor investors, which the question you asked would come on your board. If you want to
Mm.
grow your business with my money, not only money, I'm giving you the leads also. Look, this is the vacuum. You can go and supply your material here. And at the same time, when you're identifying the new customers, Analyst.ai does help you in your health check also. So,
Mm.
in short, I'm summarizing this slide in a one line. Bharat Value Fund technically tries to attract as far as possible one-stop shop to the promoters of the investing company. That look, as a promoter, Sarath bhai, your job is to increase the revenue. You know your businesses very well. You are not supposed to clear your compliances. You are not supposed to bring the anchor investors. You're not supposed to go to the market. You do only one thing in life, that is called business. In Hindi, we call it as a dhanda. आप either you contract concentrate on increasing the revenue, that is production, or you concentrate on increasing the more markets. That's a core competence of a promoter. Relieve promoter of all the responsibilities. Not giving
Hmm.
money to startup.
Hmm.
Most of the companies, if you see nowadays, are more than 500 crore turnover. So
Hmm.
relieve promoter of all the responsibilities, give him only one task, increase the revenue or increase the balance sheet size of the company, then see how the promoter performs. That's what, and that can you can do only and only if you are not only a financial investors. So that's what this slide is about. Any questions I can answer, otherwise I can go to the.
No, since I've listened to your to your previous sessions as well, and we've discussed this at length, I'd want to instill a question here because I know the kind of questions that are going to come a little later in the towards the session. Now, you mentioned that you're not just a financial investor, which means with this last two, with these different four verticals that we're speaking about, this one as slide over here, we are talking about you helping small businesses, or rather medium and small scale businesses, to scale up with and all the difficulties that come in the way of scaling up. For example, compliances. For example, with scale, you will probably have to look at getting many more vendors. And what if you select the wrong vendor and then probably chase leads that are going to be almost ready or low fruit hanging kind of fruits, and not necessarily having to now start spending way too much more money on marketing, sales, or whatever it is for that matter. Now, with that said, what are these companies? What should be the pedigree of these companies? Are we completing that in the next slide, or should we tackle it here?
I would immediately cover that in the next slide.
Okay.
Pedigree of the company. But before that, I just wanted to tell you the entry exit mechanism. How where do I enter, where do I exit, and then I will go to the pedigree. So
Yes,
your
please.
slide will be the slide number 3. I'll
Mhm.
speak probably 5 minutes on the next slide.
Sure.
So friends, this is where I'm going to, pictorial presentation always helps you in understanding the better. You can see all my presentation. I have been flashing this slide every day and night. So this is a life cycle of any particular company. In a simple way, where my cursor is there, Sharath is the point of IPO. The left
Mm-hmm.
side, the pre-IPO, right side is the post-IPO. Very.
Right.
Now, what am I trying to do? This fund is neither a startup game. This is a startup. So neither I'm not using the word risk, but there are certain challenges while investing in a
Mm.
startup. Let's
Mm.
accept. So neither this fund is taking a bet on a startup companies. At the same time, my companies are not listed also, because listed companies tend to have the slightly higher valuation. So neither the risk of going concern is there, nor the risk of higher valuation is there. This is exactly in between both of the things. So the
Mm.
company is grown up. If my AI has to work, Sarath bhai, there has to be something to check. AI will work when the data is there. In
Mm.
startup, there is no data. So how can I check? So in my grown up companies, there is a balance sheet, there are the debtors, there are the creditors, there are the suppliers. So my people can check. My AI will work. So my AI will work
Mm.
if checking mechanism is there.
Mm.
So this is exact.
Don't
So
worry.
what I'm trying to do is technically, uh, it's called business. See, ultimately, you know that comes on the date of IPO. It's like mutual fund, insurance, and bank,
Mm.
and they have become sizably very big. And since we have done so many IPOs, so we know probably their selection criteria. See, ultimately, structure the product keeping in mind the requirements of your buyer.
Mm.
The probability of you getting success is very high. There are
Mm.
two things you can do: either manufacture what you can manufacture, or manufacture what your buyer wants.
Mm.
Probably I'm in both the categories, because mutual fund, insurance, and bank, the earliest point, see, they're probably getting what 30,000 crore check at the start of every month.
Mm.
And that's why the market is not falling, because that's the strength
You're
of
referring to it, the fresh SIP input, that is the SIP book that's there in the country. Okay, great.
exactly, is not going
Mm.
to fall. And that
Mm.
SIP deployment cannot happen in unlisted market. This area, they cannot come.
Mm.
Outside country, they are not going. The earliest point they can come is the point of IPO.
Mm.
Bharat bhai, and probably we know the selection criteria of mutual fund, insurance, and bank.
Mm.
So whatever anchor investor selects, which is going to come in the next slides, imagine you invest in a same quality of assets 2 or 3 years before that, not 6 or 7, 2 or 3 years before that. In
Mm.
2 or 3 years, put that in a process called as IPO. Repeat, it's a process. It's a
Mm.
well laid down process. Complete the process of IPO, give it to a mutual fund, insurance, and bank, and you try to exit. That's my business model. And that is what
Mm.
I've been doing in series 1, 2, and 3.
Mm.
So whatever, practically, try to mirror image the selection criteria of larger investors 2 or 3 years before your investment. Try to mirror image that 2 or 3 years before that. In 2 or 3 years, put that in a process called as IPO, which I have done so many times. That's where we have done 118 IPOs. Complete the process, give it to them, and try to get out. So I am not speculating anything. That's why if you see companies, they're straightforward companies. So where I have invested, or probably what do they like on the data of IPO? It's very simple. It's not a complicated thing. 6 or 7 criteria maybe. Number one, grown-up companies. Probably the anchor investors will not invest in a startup companies because India market is still yet to see a IPO of a startup. US has seen that, but India is yet to see that. So what we want is a grown-up company. Say point number two, 500, at least 1,000 crore turnover. Point number three, most important is promoter having substantial stake because that's where ultimately promoter is a jockey. He's going to drive the car. So promoter having substantial stake. Point number four, he's reasonably profitable. I'm not talking about a very highly profitable, reasonably profitable. Point number five, compliances are well laid down. And point number six, if possible, the second generation is into the business. That means the promoter is looking at long runway. Sarath, I want
Mm,
to ask you a simple question.
mm,
I'm giving you six credentials. Say 1,000 crore turnover. The company is reasonably asset backed. The promoter is
mm,
having substantial stakes, say 70-80%. His second
mm,
generation is into businesses. His
mm,
compliances are well done. Have you seen this kind of a company is going bust? Very rare. Very rare.
mm.
That's very rare.
Sure,
So
sure.
what happens? Technically, you are
Mm,
hitting the safety quotient of anchoring.
mm.
That's a safe haven.
Okay.
Believed to be. There's nothing safe in equity. Let's accept this fact. But this is believed to be a safe haven. So
Mm,
that is what if you see my all investments I have done in series one company, series two companies, series three companies. Saradha, you know each and every company. Whatever criteria I mentioned just now, you will see 85 to 90%. Though I wanted to qualify up to 70-75%, 85 to 90% criteria I mentioned just now, all the investing companies follow.
mm.
So till today, whatever I have invested, 85% of the companies are asset-backed companies. More than
Okay.
80% are PAT positive company. Nowadays, very rarely you see unlisted PAT positive company, but all, most of my companies are PAT positive. Series 1, in fact, all companies are PAT positive. Series 3, both the companies are PAT positive. Very rarely you'll see. For example, the
That
last company.
positive is profit after taxes, and whatever is remaining, it's in the positive.
Yeah, 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 yeah.
Again,
Then
I'm bringing that in because, like you said, our audience is not necessarily used to all these accounting terminology, so I thought it was important that we mentioned it. But please carry on.
So this is how I manage the company. So as I said that series one plus two plus three, whatever investments I have done, as I said, more than 80% money given to asset backed companies, more than 85% money given are to PAT positive companies. Most of the company, if you see, promoter are having very substantially high stakeholdings. So the lowest promoter shareholding will be 79% in any of the companies, even after my arrival. Most of the companies have second generation is into the business. So what I'm trying to do, Sharath Bhai, over here is that try to map the mind.
Mm,
I used to work very closely with Goldman, and that my Goldman boss told me one thing: mind mapping is more important than the watertight agreement. This is a very important point. If
mm,
you are 1,000 crore, you are asset back, you are reasonably holding your equity, your second generation is into business, and you want to go for IPO. Sir, the probability of you backing out is very less.
mm,
Agreement is secondary, mind mapping is primary. That's what I believe.
mm,
I
mm,
map the mind that now you want to go for IPO. There are kind of a promoters who every month they are in the race of selling their equity. Sorry to say, very rarely you see investors making money over there. They are the promoters who will make the money.
mm.
See, promoters' equity, since you say most of the people are not from finance background, at least they understand cricket everywhere.
This is ownership. Mm,
Right. So promoters' equity and batsman's wicket goes hand in hand. The batsman who learns how to keep a tag on his wicket tends to become a bigger batsman. The same way, the promoter who holds on his equity, who puts a price tag on his equity, is not willing to sell his equity every now and then. By default, he also become rich, and by default, his investors also become rich.
mm,
So that's what very important. Even if you listed, you see the companies where the promoter is having substantial stake. Cyclically, that company will go down. There is no solution for that. But when the market turns in their favor, the same companies goes up, their share price goes up very fast. Why? Because the promoter is there. Always put, mother used to say, never invest on a horse. In a different way, I would say that stock is like a horse and promoter is like a jockey. So I'm not investing on a stock, I'm investing on a jockey. So promoter pedigree, you use the correct word. Promoter pedigree is very, very, very important because he is driving the entire car, and you have to bet on him. So that's how the thing is there. I was trying to be layman. Now my last second last slide is coming. Is what have been my selection criteria or what I wish to follow. So friends, you can see since series 1 when my AUM was zero, probably I was using the same slide, and today also I'm using the same slide after raising almost 600 crore from the market. We have never changed on our parameters. So people say that you're becoming big, might be yes, but we are not changing our core credential. So wherever I invest in any companies, or probably whatever companies I have invested in series 1, series 2, series 3, you will see that more than 75 to 80% these credentials matching. And I'm going to explain this over a period of next 7 to 8 minutes so that everybody becomes familiar with what companies could be coming their way. So IPO conviction. Sarath bhai, I'm talking about the entry credentials. And the
Mm,
entry starts with the exit. IPO credential. Whatever companies I have invested till today, there is a non-negotiable clause that the promoter is to go for IPO in 30 months. Let's accept today only. Let's agree today only that you want to go for IPO in 30 months. If yes, then okay. If no, then no. So that's called
mm,
exit potential. Plus, that's a background of Pentiment Group also of doing so many IPOs. So that's where I start the business. Let's agree exit because ultimately my end game is exit only. End game is not entry. End game is exit. So let's agree today only. Second,
mm,
straightforward businesses. Because if you want to have the retail participation on the date of IPO, in Hindi we call जो दिखता है वो बिकता है. You buy what you see. So if you
mm,
start giving you the complicated assets, probably investors will shy away. That's why most of my companies are very straightforward. I can explain my companies in 1 month second. हल्दीराम क्या करता है? भुजिया तलता है. Aniket Metals, what do they do? Kitchen utensils. Viera, what they do? They manufacture TV, fridge, washing machine. Murudar Rocks, what do? They manufacture the cords, which is kind of a kitchen top, engineering marbles. Nurturewell, what do? They manufacture the biscuits. As simple businesses are there. That's why invest in a straightforward businesses because end objective you have to attract retailers also and you have to attract institutions also when you want to sell. So
mm,
attracting bigger investors and attracting retailers become very easy if you invest in straightforward businesses. That's why predominantly 85% money I have given are into the asset-backed company. I have given money to the AI companies also because you are from Bangalore. That's a matter of good thing. But one thing I would like to say, many people talk about AI, but I have seen the financials of most of the investors, private equity investors who have invested in AI. They only talk, but very rarely have seen the balance sheet. The two AI companies I have invested, both are having profit after tax. Yes, rightly said, is in excess of 100 crore. Amnex is a revenue of 750 crore with a profit after tax of 150 crore, and Viera having a revenue of 900 crores with a profit after tax close to 96 crore. So these are not a startup companies at all. Though I have invested 15% into AI, both are highly grown up and highly profitable companies. So that's where I'm. Second, regional brand going to national brand. Sarath bhai, this is where probably you can make the extra money. It's like if you want to make money, there's only one way you can make the money. That's what I always say. Enter low. For
mm,
example, if this mobile is worth say 100 rupees. No way, Sarath bhai, you can sell for 105 rupees. You cannot
mm,
sell costly. You can make money if you buy cheap.
mm,
What do they do? We always invest in a national brand because some celebrity is investing. If some celebrity is investing, we blindly follow that. Point is, I'm not saying whether that tactics is right or wrong because many people do that. The point is, if you're following a celebrity's footstep, invariably the asset you are investing is costly in nature. What we do, invest in a regional brand, help that brand to become a national brand by giving them money, by giving them
mm,
leads, what I said, and by giving them analyst.ai, giving them the brand ambassadors. So if you invest at a regional brand and if you happen to exit at a national brand, between entry and exit, very important point, whatever profit you earn, but because of brand valuation, you make extra money.
mm,
It's not only about the profit. Profit
mm,
100 at the time of entry, profit 200 at the time of exit. You make 100, but because of brand awareness, you make extra money. So regional brand, you get at a lesser evaluation. It's all about enter low. It's not about exit high. You can't exit high. I do not believe that you can exit high, but you can enter low. So it's all about
mm,
enter low. That's where I enter at a regional brand. So if you see
mm,
my last exit, which was 8.6x in 17 months, silver consumer electricals, the balance sheets of the company went probably three and a half times between my entry and exit, the revenue. But extra return I got because of the brand awareness. So that's where we work. The next is substantial promotership equity, which we have been talking a lot. Sarath bhai, see, across the globe, be it India, be it US, I know you are investors from US also. Equity is not a safe instrument at all.
mm.
You cannot assure a safety beyond the equity. But then what is the safety? So my biggest safety is promoter shareholding. Because the promoter is having substantial stake, then probably, as I said again, mind mapping is more important than the watertight agreement. Map the mind of the promoter, probability of failure is less. The
Mm.
next 2 point is where I make the money.
Just to add, Nishad, because we've touched upon promoter holding multiple times. In simple words, my point is there is more skin in the game, or there is more returns that the promoter will get with all things going right, simply because his ownership into the company is much higher when compared to, let's say, a fund like Bharat Value Fund or anybody else who's infusing capital, and they're having, let's say, 20 or 30% ownership. Because for him, the the pie, the size of the pie is much larger, and therefore the benefits will be much larger if everything is put in the right place.
Absolutely. Absolutely.
Okay,
Correct.
let's continue.
Next 2 points, slightly technical. I will put it non-technical.
Hmm.
So growth capital. See, predominantly when you invest in an unlisted market, we see that most of the time we do secondary trading. Secondary means what? One investor selling it to another investor. I am
Hmm.
selling it to you, selling it to somebody. Can the balance sheet size of the company really grow because of that? No, no, Sharath bhai. Because I am selling it to you, the company is not getting any money.
Hmm. And
What?
again, it is not in the listed space, therefore there will be gray market prices also. So we really don't know whether there is a whether the price that we're paying is actually the price, or there is a different price, or it's just, we don't know the story at the back end. So yes. Hmm.
Correct. So what we do, if you look at all my series, is we have given more than 85% of the money as a primary. Let me explain the difference between primary and secondary. When you give the money to the primary, you invest money into the company. When you invest money into the company, company gives you more shares. As a result of that, company has got the money. So say yesterday company had 12 machineries, now the company will have 20 machineries. Because you have given money to the company. Because of
Which
machineries have
means
got,
now,
the
which
revenue will.
means now, I'm sorry. Yes. To put this in simpler terms, we are giving money to the company to boost the business or boost the productivity, to boost the revenues of the company, not necessarily for, I mean, in fact, not with the intent that we buy out somebody else's shares or we try to give exits to anybody else. The intent is that the revenues should increase whichever way. We are either talking in terms of higher sales, higher new customers, new regions exploring, whatever, or getting more plant and machinery, whatever the story is.
Correct. Because if you see, never chase the valuations.
Hmm.
Try to increase the balance sheet size of the company. If you increase the balance sheet size of the company, valuations will chase you.
Hmm.
And if you want to increase the balance sheet size, which is revenue and profitability, you have to give the growth capital. You cannot do secondary.
Right.
So in primary, you increase the number of machineries. In secondary, you increase the wealth of the exiting promoter. So that's what always say that primary is more important. You increase the balance sheet size of the company. The margin of safety, that's where we make the probably, if you see the listed and unlisted space, you should get unlisted space at a lesser discount, mainly because of the liquidity.
Hmm.
So two companies, say company A and B, both are in the same sector, same segment, same revenue, same profitability, but A is listed, B is unlisted. By
Hmm.
default, A will get a better P multiple. Why? Because A you can buy Monday, sell Friday, but B you
Hmm.
cannot. So
Hmm.
that you come at a lower P multiple. But the moment B gets listed, you tend to get that extra money. So that's why you see any of my company I have invested till today, the P multiple or the revenue multiple at which I have invested. And if the peer multiple, which is listed, you see their P multiple, you will see more than 30-40% gap. And the day you list, you try to pocket that. So that's where you make. So basically, the formula for valuation across the globe is very simple. Profit after tax multiplied by the P multiple is equal to valuation. It's a simple function A multiplied by B. Give the growth
Say that
capital.
again. Say that again. We are talking about.
Profit after tax multiplied by the P multiple is equal to
Hmm.
valuation, or revenue multiplied by the revenue multiple is equal to valuation. A multiplied by B is equal to valuation.
Hmm.
The simple way, the day you enter, the day you exit, you have to increase the A, you have to increase the B. If you want to increase the A, you have no option but to give growth capital. Moment you do secondary, which is most of the unlisted market is doing, you are removing the probability of increasing the A. Then you're
Hmm.
only dependent upon the B. Why
Hmm.
this fund better performing? Because we have given more than 85% growth capital. So my A is also increasing, which is the revenue or profitability. And moment the compliances are clear, the liquidity of the fund increases. Because of that, the B increases. So double
Hmm.
the A, double the B, you make the valuation, it becomes 4 times. It's a simple
Understood.
add. So concentrate on A, concentrate on B. Proven
Mm,
track record, sir. The youngest company in my portfolio would be 13 years old. My AI will work if the data is there.
mm,
Check cash burn. Mostly, if you see unlisted companies, sorry to say, most of the time I see there is a problem with the profit. But I have
mm,
given series one, all the companies are profitable. Series two, all the companies are profitable. Series three, all the companies are profitable. Invested till today. Series two, except one, all the companies are EBITDA positive. So that's what I said. Check the cash burn. Let's revisit this credential once more time. One by one. IPO conviction gives you an exit because exit is very important. Straightforward business helps you in attracting retail investors or institutional investors on the date of your exit. So you ensure your exit if you're because if you're where you're invested, Sarath bhai, if the investor do not understand that, they will never invest.
So,
Regional
in other words, to make this more relatable, we are prepping businesses such a way that large institutions who want to invest in their company for these large institutions are people that have retail funds, investors who are putting in SIPs, lump sum investments. I'm not talking about institution, but these are people who are the similar kind of people who would go about trying to take a Lenscart's IPO or whatever it is, general public.
correct.
Okay.
Regional brand going to national brand, probably there I'm playing on the brand valuation also. So it's not only profit and the P multiple, I'm playing on brand valuation also. Substantial promoter holding gives me kind of a little bit safety cushion. That's where probably if you ask me why there are no accidents till today in my fund, probably
Hmm.
this is the reason I can tell you. Growth
Okay.
capital and margin of safety is A and B, what I explained, where I train to make the valuation. So
Mm,
growth capital, number one, P multiple, number two, and brand valuation, number three. I try to play on all three. That's where I'm
mm, mm,
proven track record. That's where my artificial intelligence works and check cash burn. Sarath bhai, I have been speaking this. The right side is walk the talk. Series 1 and Series 2, I have probably deployed what I have said. And that's where
mm,
the performance is thing. One thing I can tell you, if you try to follow this chart, I cannot assure you any return. Nobody can assure the return. But one thing I can tell you, you will train to one win on the law of averages because the accidents will be lesser. There's
mm,
something called as a high risk, high reward, which many
mm,
people, sorry, my fund house does not believe in that statement. High risk, high reward, no, sir. Lower down the risk, you tend to win on the law of averages. Again, it's cricket.
mm,
You got 12 players in 11 players in cricket. I have 11 investing companies. If
mm,
two people score the century and rest of the companies burst, you can never win the battle. India is winning
mm,
nowadays because everybody is scoring. So this formula will not ensure you that you will get 100% success. But what can ensure you is your losses will be minimized. And since your losses will be minimized, you will tend to win on the law of averages. Ultimately, you have to win on the law of averages.
got
So
it.
that's where Sarath Bhai is there. So my third slide is over. If you wish, I can quickly talk about the fourth slide, which is up.
Please do. Please do. With the complete disclaimer that past performance has nothing to do with future performance, even though the intention is there to get outperform, but it is no indicator of future performance. I've done that job. But go
Yeah.
ahead.
Never drive the car looking at a rear view mirror. So series
Correct.
one was a 500 crore fund. We started in April 22. It was tough to raise the money. It took us 18 months to raise the money. So series one, we have recently released the MOIC, multiplier on invested capital, which was 1 crore was becoming 2 crore 80 lakhs as per the reported within 17 months of a final drawdown and 2 years of a final closure. Wherein already we have written the 60% and ensured the liquidity of more than 100% within 2 years of the investment. So when the series 1 performed, the series 2 started in July and where it took us 18 months to raise 500 crore. In series 2 we could raise 2000 crore within probably 4 to 5 months time. And series 2, the MOSC were recently released. It is also relatively high where the Haldiram, the Prabhuji is there, which you asked me before the start of the call. That is also trading at 1.5 times within average 7 to 8 months holding. And series 3 we have started is yet to be closed, but series 3 is almost at the fag end of its career. And series 3 another 2500 crore fund where also we have recently released the MOSC, which is 1.6 times. So if you look at the relatively IRR, what people understand, so far what the series 1, 2, 3 have generated the IRR are in excess of 40%, but against there is no assurance of the return. That's a mandatory clause I have to say. So at the interest of the people, we have started the series 4 recently. And series 4 minimum ticket size as of now is 1 crore. The first 500 seats would come at 1 crore, out of which I guess Dashni can correct after this call how many seats have been filled. Right now the drawdown is only and only 10%. You do not have to give the entire money upfront. Right now the drawdown is 10%. And the balance will come over a period of, you can expect 9 months to 1 year in 4 tranches, maybe 20-25% tranches that we do. So this is a 5 years fund where you enter into the tranches and you exit into the tranches. So it's not a one stock you have to give 1 crore. You have to give 1 crore over a period of say 9 months to 12 months, and exit as and when we exit, we return the capital.
Got it.
So that's how the fund is there. And other than that, also we keep on happening our making our webinars very frequently. So if somebody has missed out anything, we have hold two webinars every week where your investors can come and attend the webinar. And series three, if any, I understand some NRIs are there. Series three, if somebody wants to come, we have a gift city filter. So NRI investors can come into our gift city through series three. So
Okay,
that's
but
the
then again, the ticket size there will be at 1.5 crore.
150,000 US dollars,
Hmm.
and they have to invest because that's the rule of the gift city.
Sure,
No,
sure.
IFS, and what they have to give is only 50% right now.
Hmm.
But the series three is grown up, so they will get a little bit benefit of a time value of money.
Basically, what you're saying is the company, they will get to invest in companies already that have grown, but the valuation will be at the site where they got in about a year and a half back, or whatever the story is.
So series two, series three technically looks slightly advantageous, but of course series three, four will also have the similar this thing. But ONRS can come through Syria Gift City Fund.
All right, excellent. Now, with that said, anything else that you'd like to add, Nishad?
I would like to show a board of directors once before we go ahead because
Yes, by
ultimately
all means.
the stronger board is also equally important. So just one
Right.
second, I would like to show the board.
Everybody else on the call, as while Nishad is bringing this up, if there is any questions that you'll have, please use the raise hand icon, and I will allow you to unmute your lines, and then you all can go ahead with the question. But please have your videos turned on, at least when you're asking the question. Right? Yes, please go ahead, Nishad.
So this is the IC committee, sir. So myself and Miss Madhu Lanawat. Madhu is the employee number one. I am the employee number two. We started the series one together. Madhu is a rank holder chartered accountant, and she was youngest CFO of the Edelweiss Asset Management. You must have seen recently the youngest lady or the first Indian lady to start the mutual fund. You know her personally very well. And as we started the series two, Prasanna joined us. Prasanna is the CEO of a Taurus mutual fund. Imagine a CEO of a mutual fund is sitting on our IC. So
Mm,
where I'm heading to. And Tejas helps all the promoters to execute the business plan. Tejas was a part of HSBC. So all the
mm,
investments happen has to be approved by all four of us. That's the IC committee called as the investment committee headed by
mm,
four of us. Uh,
mm,
Coming back to the independent board, we have Ram Sevak ji, the three IS officer, all three listed on your screen are three IS officers.
mm,
Uh, Jalan Saab was very instrumental in from the PF industry. Ram Sevak ji from the UDI, that is Aadhaar, and Rashmi ma'am was a part of Ministry of Finance. Then, of course, Mr. Hemant Bhargava is also on our independent board, who was the chairman of LIC. Plus, we have beyond the IC committee, we have Mr. Saro, who was the first employee of Reliance Retail. Saro helps my investor company in brand creation. So McDonald's was very famous in South India. Saro was instrumental for that. So Saro does help my investor company in that point. If you remember, regional brand going to national brand, that's where Saros come into the picture. We
mm,
have Singapore also. So Vikas helps my investors based out of international market to guide their investor relation services. And Mr. B.Y. Joshi is our chief operating officer. Prior to that, he was the operating officer of 361. Now he's the chief operating officer of Bharat Value Fund of the wealth company. So that's where wealth company has two arms. The first one is, of course, the flagship product of the wealth company is Bharat Value Fund. We are into series four, and recently we have launched our mutual fund also. Last month we had our mutual fund where we garnered close to 2,000 crore in as a NFO, and our next NFO in mutual fund is also coming, multi assets. You know about all those things. So that's collectively, if I'm not mistaken, Dashni can correct me if I'm wrong, but we are managing close to 10,000 crores under AIFs and mutual fund put together as a wealth company. So that's how we
awesome.
are.
Excellent. Any questions, ladies and gentlemen?
Dashnik, you want to say anything?
Very
You can
impressive,
you
yeah.
can highlight if
In spite of me butting in every now and then, we managed to complete this within 50 minutes, which I think in itself is a record, because generally my these webinars go in for 90 minutes, and I think you've done the job very well. I mean, it's great to see that we are completing within 60 minutes. But yeah, I think we will open for Q&A. folks, if there are no questions, I'm going to ask Darshanik and Nishad to drop off the line, because I'm going to be telling all in terms of what are my thoughts and so on and so forth, because this is going to be on record for future use as well. And this should be something that we can use as a reference. I wouldn't want to put in their time for this. Any questions for Nishad and Darshanik, ladies and gentlemen? Okay. While we still have you on call, Nishad, I have a few questions which I'd like to ask. Okay. You've mentioned that there are good amount of exits that you've had, and the IRR is, rough at an average of 30 odd percent, 30, 40 odd percent. Now, you've mentioned all the different pointers that y'all do, which the selection criteria, which minimizes the downside. Okay. But let's say for some reason y'all overlooked, or y'all diluted this checklist for one or two companies because it seemed very good. What is the downside protection that y'all are putting in place in case things were to go down south?
Okay, it's a good question, Sarabhai. So this is basically a multiple lever of exit. The 30 months you have to do for IPO. Otherwise, I can sell my, if that doesn't happen, then I can sell my stake to somebody. Otherwise, there is a buyback clause. The multiple clauses are there. Plus, I have my own IB, investment banking, very strong. So that's
Mm,
not only the IPO, it's about secondary sale also there come, because my last exit, ATEX, was not the IPO, but the secondary
mm,
sale. Why? Because my
mm.
IB was very strong. So
So when
it's
you're saying secondary sale, some other business house bought your stake out instead of having to get it listed in the market.
correct. Some other big
Understood.
fund bought out my stake in that particular company. So for
Mm,
that, you need to have. So it's the entire ecosystem we have developed. But
mm.
Saurabh, if I'm trying to understand your question correctly, you're coming more from the market cycles. Let me tell you one thing. In
No,
my
not necessarily market. I think, okay, then, just to make it absolutely clear, our timeline is usually the 3 year, 2.5 year to 3 year, even though you got 17 months, but on your offer document and everything, it highlights at least a 3 year holding period is what you're anticipating. Now, markets could be down, global sentiments could not be too well, right? Even though the macro factors is not something that is going to be in the same proportion going to impact the Bharat Value Fund, but what are those downsides that we can do, and what can we do to revive it if things don't seem as rosy or as robust as it is right now?
very good question. So I always tell my investors that look, I doubt if any fund manager in the world can catch the market cycles. They can
Hmm.
understand it much better, but they cannot catch it. Nobody knows what is the bottom, nobody knows what is the top. So cycles
Correct.
will come and go. Cycles will come and go, but you can do two things. Number one,
Hmm.
try to enter at a lower valuation,
Hmm.
clear the compliances, and wait for an opportunity. Tell me one thing, in last 4 years, Corona is a gone event. It was the worst event in the history of the mankind. The market was back to normal in 10 months. In last 3 years, what not events have gone against the market? Market fell many times. But within
Hmm.
3 to 4 months, it bounced back.
Hmm.
So I am
Hmm.
not in a product where I have to get out on Friday morning. No,
Hmm.
that's complete the compliances. Once your compliances are complete, regulators did not tell you that, okay, your compliances are complete. I have approved the IPO, bring IPO tomorrow morning. No, you have 1 year window. If you're expecting that throughout 1 year the market will be down, that's a very rare possibility, sir. So market will give you an opportunity. You need to do two things. I repeat, enter low, clear your compliances, and wait for the opportunity. Market will give you opportunity in 3 to 4 months time. That's my
Hmm.
business model. I am not speculating on the market.
So your idea is, if nothing else happens, there is at least a 25 to 30% discount value. So even if things were to go down south or whatever, it gets delayed, we are already sitting at a 30% discounted valuation. Number one. Number two, when things when things bounce back up, right? The recovery will be much faster, and you have an earlier exit when compared to having to wait for the ideal thing in terms of when I bought this mark to market.
Correct. Recovery would be better. That's the correct way you have mentioned. Recovery would be better because markets will behave the way they want to behave. Fund manager should not be behaving too much on this thing. As I said, enter low and be ready with your compliances. Should be in
Now
a
I have another question, which I'm going.
bowler will give you a loose ball, but maintain your wicket. Indians understand cricket very well. Bowler loose ball देगा, but आपकी wicket गई तो आप छक्का नहीं मार सकते हो sir.
One more thing I want to add is to Nishad's point. Why let's not only let us give us some facts. Last 1 year has been very bad for markets, for the listed space.
Mm,
This year is also not so great. This year only we did one IPO for an investee company. Okay. And we are already sitting at 2.5x when things are not so great. So
Mm.
which is where what Nishad was saying, that enter low, that helps,
Mm.
right? Even
No,
when
Darshit, see, I get that. And the reason why I'm pointing this out, because a good majority of the folks that are available on this call today and who are going to listen to it in the future are people who have, listened to nice, rosy, well-crafted marketing pitches, right? But unfortunately, when we put our own money, that's when things don't work out too well, right?
absolutely.
Now, why I'm highlighting this is I want to play the devil's advocate here and mention specifically that this is a 3 to 5 year game and nothing that's going to happen over the next 1 year. And while there is, while it's an equity product, the underlying is unlisted businesses which are already profitable, and we are waiting for them to get that because of the growth infusion that is coming in terms of capital, the scalability, and all the other things that will need to happen to make that business scalable is going to require a 2 or 3 year timeline. Excellent. Now I'm going to Girish and Praju. I see you all having questions. I want to make this a little more interesting and conversational. So I'm going to ask another question. So this might probably be of interest to all of us, and then we'll take your questions. Right now, Nishad, I've seen about 4 different call recordings of yours on 4 different platforms. Okay, and you'll give this secret formula of yours or this checklist. It's out in the open. I mean, anybody listens to a call recording, which means now 10,000 crores is large amounts of asset. It's not that y'all are the largest. And there are some AMCs with their individual schemes much larger than 10,000 crores, right? So I know the answer, but I want you all to answer this for lay people. I'm not talking about fund managers or wealth managers. What is stopping people with much, much deeper pockets to do exactly what y'all are doing? What's stopping them to do this?
Market is very open. You cannot have a secret sauce as such, because if you have a secret sauce, rest assured somebody is going to copy it.
Mm,
So, I personally believe that if you want to become successful in anything, what matters is the ecosystem. Why probably US markets are performing bigger, because they have the full ecosystem to even the startup can go for the IPO. So ecosystem matters, and if somebody can copy the entire ecosystem, what I showed you in the size slide number 1,
mm,
he can copy my performances also.
mm.
But maintaining that ecosystem takes a 12 years of hard work, and that's where the I would say the better results lie. That's my honest answer in a one way. Then the ability to do back to back 3 IPOs in a year, ability to have somebody like Asit Mehta on your board who knows all the institutions, huge amount of investments into artificial intelligence where your due diligence can practically happen within no time. If somebody has the ecosystem, yes, they can copy. But copying the presentation, copying the PPT, and copying the ecosystem is a big difference, sir. You can copy the first 2 part, but copying the ecosystem is a challenging thing.
So what you're saying is the success for the results that you'll have had as an AMC is not necessarily only the fund manager. It's not necessarily only, let's say, who the investment committee is. It's the entire process that you'll have put in place and everybody else that you'll are depending on to make this ecosystem work. So it's the ecosystem that is giving all the success.
Yeah, 100%. Ecosystem matters,
Okay.
sir. It's a
All right.
result of ecosystem.
So we'll take Raju's question. Raju, please unmute your line and go ahead, please.
It's really interesting. Thanks for taking us through in a simple floor, 4 slides, Nishant. I have 2 questions. The first one is you mentioned that for last, third series almost is in a closure stage. What are those IPOs you have listed companies? How the performance of last 3 series? Do you have any data
So
and how those performance were? Yeah.
immediately after this call, what we release is that the impact letters for every series, that where we are invested, at what valuation we invested, how the company is doing. But impact letter for series 1, series 2, and series 3 is with the Sharath bhai.
No, I
Immediately.
think the best thing to do, Nishad, I think this is a very good question, and Raju, thank you very much for this. What we will do is, please share with me a spreadsheet of the names of the companies, which series they belong to, and potentially what kind of an exit that we had, because then at least that will give some. Although this is not, at least my audience is not going to fall only on that, but it's good amount of information to at least fall back on. So that is one. Thank you very much, Raju. What's the next question, please?
Within 10
In the
minutes of this call.
first, okay, thanks. Even the second part of the first question is even on fourth series, which you are raising now, if you can give some names of those, if you have already in mind as well.
I can give you the sectors, Rajuji. The
Okay.
sectors would be
Okay. The subject to, I know it's under formation stage at this point. I just want to be.
Not only that, Raju. The reason is, see, from a regulatory standpoint, there are certain things that can be mentioned and there are certain things that cannot be mentioned, right?
Absolutely.
This is number one. Number two, this is not unlike a PMS. Now, today, if I have 50 lakhs, I put entire 50 lakhs and I get my account statement. Here, if you notice, the structure of how this AIF is getting created, you are investing in a new series. Now, unfortunately, it's not something that's open-ended. As soon as they get to that stage that we are looking at, let's say raising 2000 CR and that is done, then this fund closes. And that's when you get to the next series, as and when there are opportunities that come in. Therefore, you're putting in monies in tranches, and the starting amount is at 10 lakh rupees, which over a span of time, hopefully within 6 to 12 months' time, you will be required to put the rest amount of the money.
Yeah.
And I'll see how we're going to be funding it. That's a different, we will have that when we're individually having our calls, right? But the intent of having this call is to get ourselves exposed to an asset class that we will not have exposure to under the current ecosystem that we currently have.
Yeah. Thanks.
I'm sorry.
Quickly, my second question is, you mentioned that you have a starting ticket of, you start with the 10% of the ticket size of 1 crore and it will return of a couple of months. Then you have 4 tranches. Also, you mentioned that you will have a systematic exit. Can you explain that, how it works?
So what happens whenever, for example, last series we had exited the company and the fund life was still open. So whenever we exit, we return the capital. So
Okay.
that's how we work. We do not return the entire capital together. So whenever the exit happens, the money comes back to you. So you enter into the tranches, you exit also into the tranches. So for example, for series one of the investing company of the series one, I exited just last week. So probably within 10 days, the life of the series is still open. Still, I have 1 year to close the fund. But since I have exited, I'm going to return the money within next 10 days time. So that's how it.
To build on that, Raju, the reason why they return the money, because if you see the offer document, right, in terms of how they charge and everything, for them, just like we have a couple of other products of ours where, the charges are based on the profits that is being charged, right? For them, it doesn't make sense to redeploy the money. You need certain amount of time. Now, instead of redeploying the money, they're better off starting a new series as compared to reinvesting the money. You will also feel nice that the fact, okay, I had locked this money in for 5 years, but I've got certain amount of money coming back, and also helps you in the tax mitigation. Not all of this money you need to pay taxes in one shot.
Okay. So what is the lock-in period? That makes me ask this question then. What is the lock-in series?
There is lock-in and no lock-in both. So basically what happens is that as per the regulation in close-ended fund, you cannot ask for the redemption. But whatever you invest, the unit comes into your bank account. If you want to exit, the secondary sale is allowed.
Which means somebody else can buy your own investment.
Okay.
You can transfer it to somebody else. Yes.
That's allowed. So you're
Thank
not
you
locked.
very much.
If you want to exit, you can secondary sell. That's legally valid document. It's a part of our PPM also. Though I can tell you that total investors are close to 2,850 by now till today, series 1 to 3, and only 3 or 4 investors have backed out till today. That's what my record says.
Thank you very much, Raju. Girish, you can unmute your line. Please turn on your video and ask the question.
Hi, first of all, nice presentation.
Thank you, Girish.
Yeah, I'm Girish Kulkarni. So it looks to me is nicely integrated. All the needs very well done to integrate the whole ecosystem. But I would like to know who are your competitors, because it looks like you are the first one you have done, but previously also people used to bring the IPO. So you are the only one, or there are competitors for you also? That I would like to know.
Sarajji, I guess you're recording this call, so probably Sarajji is a distributor. He reads all the wealth managers presentation. When me and Dashni goes off record, he can answer this question much better than me. So sorry if I'm not answering, because we are going on a recorded video. Pardon me for not answering your question. Sarajji can do this. Is what I'm trying.
So I'm going to now, Girish, I need to hire, because you brought this question up, Girish. It is important for us and for everybody who's going to be listening to this call. it's not that every company that is getting listed is coming from the stable of the wealth company, right?
Yeah.
What they are doing is they are specializing in picking up companies that are going to be profitable for the wealth company and the promoters and the investors. Not necessarily every IPO that's going to be coming out. For example, let's take a name, Zomato. Let's take a name, LIC, right? When these companies got listed, they didn't get listed with bumper gains, right?
Yes, yes.
It took them time to get to wherever they are. But the point what this alternative offers is the fact that you are making money even before the fund or the particular company goes public. Because the intent is okay, paperwork and everything almost certain. Now the handshake is going to get done. We are exiting.
Yes, yes.
Okay, I'm assuming the question is coming because of the similar kind of studies that IPV is also holding. But please remember that is a completely startup ecosystem, and this is only in businesses that have been existing for at least 10 years and more, if not at least 10 years, if not more.
Got it. Yeah.
Excellent.
Thank you.
Does that help, Krish?
Yes, yes. Thank you so much.
Thank you very much. Right, Kavita, please unmute your line. You can go next, but please have your video turned on as well. Thank you.
Yes. Okay. I have basically two questions. One is you said that the assets cannot be redeemed, but we can sell it in the secondary market. Are there any buyers of these assets in the secondary market? Because this is not as popular as the other funds that are there out in the market, right? And maybe I'm wrong, but if you have any data, that will be great.
May I take this?
Yeah,
Yeah, go ahead.
Yeah. So, ma'am, if there's only if we have any client who wants to sell in BVF2 or BVF1, we have 200 clients to take it because of very reason that they have already covered 2 years or 3 years. They are they're there at the end. So, but having said that, one should not consider this product if they do not have a time span of 4 years. Okay, because this is you will be at the losing end because whoever will be the buyer will squeeze you.
Okay.
Will not
Just
give
to
you.
just to add to
Yeah.
what Dashnik is saying, Kavita. See, generally when secondary sales happen, now let's say let's not look at our engagement like advisor and client relationship. Let's say both of us are astute investors. We are looking for a killing of an opportunity, right? Now let's say you've invested and I've invested as well, or you're considering to invest in the next series of. Now, just like Nishad said a little while back, that people who want to come in third series can also do that with the minimum ticket size of 1.5 and so on and so forth. Because otherwise, the entry level in that one was at 2 CR. Now, let's say I was someone who wants to exit for whatever liquidity crisis, I need the money. As a astute investor, as someone who wants to get the maximum bang for your buck, are you going to give me at market value or you'll squeeze me by at least 10, 15, 20%?
Yeah, no. So that means, see, what we are looking at is that there could be challenges when we are selling it.
That is
It's
correct.
not as
That is
easy
correct.
as it sounds like we can sell it in the secondary market, right?
No,
Okay.
no, it is not easy. In fact, what they can do now, obviously, let's say if this was your investment and you would say, Sharath, I want to pull out. I will obviously reach out to these guys and say if there is some kind of an exit that's possible. They can get us introduced, right? And after that, the negotiation is gone on the table. That's why when what Darshanik is mentioning is that it is not going to be profitable or it's not going to be in our favor. We can get, let's say, 80 or 90%. See, in that time, now let's say we are talking about 5 years. For next 3 years, you got 2 exits. Now you got some money already back. And you're saying, you know what, the remaining, even if I'm going to get a little bit of a discount, no problem, I don't want to exit. You can do that. There's no hard and fast rule that you cannot. Is it going to be simple and is it going to be always in your favor? The answer need not be. The answer is not.
Okay. So another risk averse mindset kind of a question again. The second question that I have is that you flashed a list of names that were quite reputed in the market, right? And those guys have a machinery which is working for them to understand when to get in, when to get out, how much to get in, how much to consolidate against their overall investments, right? We as retail investor, and I will still call ourselves as retail investor, even though we are going in a kind of a bulk investment. We don't have that machinery, right? So there is a certain amount of trust and something that we need to, and we don't know when the market go bonkers and We don't know when. I will not call we are not smart enough, but we don't have time enough to evaluate that and get out. So do you have some information where even investors like us have invested and made some money, or is it the first time that you are getting into this kind of collaboration?
No, ma'am, this is the fourth fund, and already 3,000 investors have invested into the fund. This is certainly not the first time we are doing it.
No, I mean someone who have made the money
Yeah,
as
so
part of the
sometime
site.
immediately after this call, we'll share the series 1, 2, 3 performances which I flashed just now. So of course, madam.
Kavita, if it helps, sorry, Nishad, I didn't want to interrupt because I'm of the opinion there must be some kind of miscommunication from our end. Kavita, just to let you know, all of these funds that have been subscribed, the 4,000 odd crores, is come from investors like you and me. There's no institute, unless those institutions are owned by individuals like us. It is not private money. It is public money like you and mine.
And it's not those, I'm not naming it because Nishad doesn't want it to name the few companies that have been listed in one of the slides that Nishad was sharing. Are those the investors or are these the investors
They
like
are
me
the
and you?
ones who will buy out our share. Okay, let's explain. I'll take this one. Now let's say we bought TCS stocks. When could you and I buy TCS stocks? Once it was listed. Is that correct?
Yeah.
Before listing, there would obviously be people who have invested, like, IPV. Great example, right?
IPV,
Founders
some
money,
angel investor,
angel investors have come in and things of that sort.
kind
We
of.
are not, they are not, we, in this case, wealth company is the angel investor, if that makes any sense. They are coming at the angel investor stage. How are they coming with that money? Collective pool of money, that is with the SEBI regulated instrument, which is AIF, Cat 2, equity. Okay. It is the public money that eventually, if I take the startup route, a series B or a series C or a series D is buying us out.
Yeah.
But in this case, the roadmap is preferably we are not looking at going through the somebody else buying us out. We are looking at going through the IPO route. But if the valuations are good, then we can also look at somebody else buying us, as long as we are getting the maximum bang for our buck, and we see that values being favorable for us. Did that help, Kavita?
Yes, I think.
Nishad, did I miss out anything? Darshnik,
No.
did I misquote anything at
No,
all?
nothing. But just for the benefit of all the investors that are, friends are there, I just want to reiterate. See, you are entering this fund in tranches, and you will get your money also in tranches. So it's not that your entire money is locked for 4.5 years or 5 years, because there is a condition basis on which we fund these companies. That is, you have to take us public within 30 months' time. If we have invested in a company in January, we will take your next tranche. Maybe I'm just giving you a hypothetical, just an example. If we take your money in January, we will invest in some company. Then we'll call for another tranche in March. Then we'll call for another tranche in July. So each and every time we will be investing in some of the other companies. Now, each of these companies will have a TAT of 30 months, right? And not necessary that all the companies will take 30 months. There are few companies which may be IPO'd within 24 months or something. So as and when we exit, irrespective of the time period, we will return the money back. So during the journey of this 4.5 years, you can expect some money coming back to you. From the day you start, what I will say is 1.5 to 2 years is what your money will be locked typically, because we need to give some time for.
Darshnik, 3 years. 3 years.
Okay.
Let it be there. Anything before, let it be a celebration. But 3 years is what you're talking.
Yeah.
Thank you.
So this is how the fund is designed. So again, your money is not locked in for the entire period. It's not that after 4 years or 5 years, you are going to get the entire money back. During the journey of this fund, you can expect some cash flows.
Kavita, if I can also add, unlike how our mutual fund portfolio or any business that is meant on assets being garnered, right? Now, let's say a mutual fund house. A mutual fund house would not want to have redemptions placed because they get a percentage on their fund management fee, correct? This particular thing also pretty much runs around the same thing, but the bigger money comes from the profit sharing in terms of how much multiple they've given. So for all practical purposes, they would want to exit much faster as against hold it and make small portions of money when you can make a 2x or 3x on the fund management fees because of excess return delivery. Excellent. Anything else at all? But Kavita, thank you very much. You always bring in questions that is going to be helpful for everybody else. Right. Anyone else? Any questions at all? All right. Well, in that case, Darshanik and Nishad, thank you very much for keeping this very short, crisp, and simple enough for my audience.